In this advanced episode, we are going to continue the previous video's left out topics. Actually, this video is the part 2 of this concept, so please, if you didn't watch the part 1, go watch it on our channel, link in the description and in the pinned comment. In the previous video we covered a lot of things. We will start from where we left. Let's see about the double bottom. Subsequently, we can see that the price pushed higher, clearing the buy-side liquidity that had accumulated above the internal high. Now we have a demand zone located at the extreme, alongside a substantial liquidity pool generated by the stop losses of retail traders. In this scenario, there is a high probability that price will retrace, clearing the liquidity below the equal highs, then touching the demand zone before reversing and resuming its primary direction. Therefore, our current approach is to patiently wait for the price to clear the liquidity below the equal lows and touch the demand zone. This offers the confluence we seek before entering a position. Consequently, we can initiate a long position from this demand zone as the market has already collected the stop losses of retail traders, and there is no further need to collect more stop losses. As a result, after the liquidity sweep we can confidently enter a trade. As mentioned previously, the primary objective of smart money is to clear out all the stop losses of retail traders. Therefore, we should enter the market after stop losses have been swept. The same principles that apply to the double bottom pattern also hold for the triple bottom. The only difference is that in a triple bottom, the price forms 3 equal lows instead of just 2. When retail traders identify a triple bottom pattern, they enter the market by opening long positions. They also position their stop loss orders just below the equal lows, creating a substantial liquidity pool ready to be cleared. As the market's dominant direction is bullish, it must trigger a significant number of stop losses in order to be able to continue its upward movement. Hence, when the liquidity pool formed by the accumulation of numerous stop losses and pending orders is cleared by the price, it signals an opportunity to consider entering a long position from the demand zone located below the liquidity pool. This is because there are no more stop loss is left to be taken. Now let's move on to equal highs. As previously discussed, equal highs fall into 2 categories, double tops and triple tops. If we take a look at this double top pattern on the left side, it's clear that the bears are in control. After breaking the recent structure to the downside, the price rallied back up in form to equal highs near the unmitigated supply zone associated with the BOS wave. The existence of these equal highs created a substantial liquidity pool above them, consisting of the stop losses of retail traders who had entered the market by taking short positions after identifying the double top pattern. In this scenario, it's highly likely that the price will move back up and clear the accumulated liquidity above the double tops, trigger the seller stop losses, touch the supply zone, and then reverse to continuous bearish movement. The same concepts apply to the triple top pattern. Numerous stop losses and pending orders are situated above the triple tops, increasing the likelihood that the price will return to clear the accumulated liquidity above the equal highs. As a result, we can consider initiating a short position from the upper supply zone. Since the market has already absorbed the stop losses of retail traders, there is no longer a need to collect more stop losses. As mentioned previously, the primary objective of smart money is to clear out all the stop losses of retail traders. To increase the likelihood of a successful trade with a high chance of winning, it's essential to enter the market after stop losses have been cleared. It's important to note that if the price doesn't clear the liquidity before reaching a point of interest, there's a strong likelihood that the price will use that zone as a source of liquidity to drive its momentum. Now let's move on to the second practical liquidity pattern that we should consistently look for in the market, trendline liquidity. Let's start with the bullish scenario. Consider a structure like the one illustrated on the left side. We can see that the price formed the bullish BOS to the upside, leaving a great inefficiency behind. Following the creation of a new major high, it retraced downward and then began forming a series of small break-of structures with extremely tiny and choppy movements to the upside, without any significant liquidity sweeps. The key factor here is the repetitive formation of the small break of structures. In this scenario, the price is slowly moving upward while forming new higher highs and higher lows that are in close proximity to each other. As a result, a trend line is generated by these minor highs and lows. Retail traders who rely on trend lines and chart patterns enter the market every time the price touches the trend line, placing their stop loss is just below it. This approach results in the formation of a substantial liquidity pool position just below the trend line, waiting to be cleared by the market. Consequently, numerous stop losses are closely aligned with the trend line and are positioned by retail traders. In this scenario, it's highly likely that the price will push back down to clear the liquidity below the trend line, triggering the stop losses of retail traders. It aims to fill the inefficiency left behind, and then tap into the demand zone situated at the extreme. This provides an opportunity to consider entering a long position from the demand zone situated below the liquidity pool. Since the market is already activated the stop losses of retail traders, there is no longer a need to collect more stop losses. The main purpose of the smart money concept is to enter the market only after the retail side liquidity has been cleared. Hence, we should enter a position only when we identify liquidity sweep on the retail side. Let's move on to the bearish trend line scenario. The same concept applies to the bearish trend line. In this scenario, you can see the price has formed a bearish break of structure and there is an unmitigated supply zone generated by the BOS wave. The price moved downward with inefficiency, and then it started to form small break of structures to the downside repeatedly. Additionally, the price created a trend line using these minor structures. This trend line made many retail traders to enter the market by taking short positions and placing their stop losses above the trend line. Consequently, a significant liquidity pool is positioned below the upper supply zone. All we need to do is wait for the price to clear the liquidity located above the trend line, triggering the stop losses and then reaching the supply zone. This provides a strong confluence factor we look for before entering a position. Consequently, we can open a short position from the supply zone after the liquidity from retail traders has been cleared and the inefficiency has been filled. There is a higher likelihood that the price will reverse from the upper supply zone and continue in its dominant direction. In this case, the bearish direction. That's it, traders. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you'd like us to cover in our future videos. We appreciate your support and look forward to seeing you in the next episode.